Hello everyone, welcome to the Stock Markets Analytics Zoomcamp 2025 edition. Nice to see you all. We'll wait for one more minute and we will start. Please write in the chat where are you from and let's greet each other. First of all, I'd like to mention that any lectures and assignments that we present, it's not an investment advice. You should use it for educational purposes and not for your investment decisions. First of all, if you don't know me, I'm Ivan. I'm a business intelligence analyst at Google. I also have educational background in computer science, finance, and data analytics, so a little bit of everything. I founded pythoninvest.com 4 years ago, where I regularly write articles and analytical stories about financial markets. And I do invest my own money. Recently, I explore fundamental data and options trading, so I write about it as well. I just released an article about fundamental data less than 1 month ago. So you might see new additional features in this stock markets analytics Zoomcamp edition. Today we will have three major topics. One is the first topic is a questionnaire update. I will share the stats that you already saw in pre-launch video stream. Then we will talk about making data-driven decisions. I know it can be quite challenging for many of you to dive into the area of finance, investing, and economics. And I've seen a lot of feedback that I'm using many of jargon words that you might not understand, but it's quite hard to combine all the knowledge in 5 lectures. So I assume that you can click the links that I provide and read some additional supplementary materials if you don't understand something. So in this introductory section, we will talk about the philosophy of the data-informed decision-making. We will overview your potential investment opportunities. And this data is updated from the last year. We will discuss what changed in 1 year. We will understand risk versus reward, some metrics that you need to choose for yourself when you try to select an asset class or design your trading strategy. And then we will look at some of the real world data examples, S&P 500, interest rates, ETFs. Later, we will talk about programming setup. That's in most of the lectures, I will use Colab. And the Colab code is already shared on GitHub. You can open it, you can try to execute it, and you should be able to replicate all the data that I show you here in the lectures. Okay, so the question section is the same on slido.com. I know that we haven't answered some of the questions from the last Q&A session, and we will do it today. But first, there are a few questions from 2024 that I believe are important. So question number 1, finance argues that prices reflect all available information, making it impossible to systematically beat the market. How will you deal with it in the course? Of course, we are not providing some winning trading strategy or always winning trading strategy, but as you may notice that there are many retail investors, mutual funds, hedge funds exist in the market, and they regularly invest. So hopefully we can make some practice which delivers positive results. And the second thing is that we discuss the relative growth or growth versus benchmark. So each of you need to define what benchmark you have on a local market, on a global market, on an asset class, or your personal aspirations. And you can compare versus this benchmark whether your trading strategy is performing better or worse. Question number 2, how much math do we need to know in order to succeed in the course? I would say that general education math. The math is not very complicated, although if you want to understand ML predictions better and go deeper into ML modeling and selecting more complicated algorithms, linear algebra, probability theory, and statistics are useful. Question number 3. Can you share the description of the video, some references for the theoretical concepts underlying strategies? Again, we just do practical aspects. Every time we deal with code, we do not cover any theoretical concepts or strategies. Question number 4 is about popular technical analysis strategies versus what we have in the course. I won't use any of these strategies. You can select them for your capstone project. What I can say that technical indicators are used as features, and indirectly all those strategies are embedded into ML predictions. So hopefully we can predict better than any separate strategy. Question number 5. Does the course follow the repo? That's my previous repo from Python Invest Basic Fin Analysis. Yes, there are references to the published articles, and almost all articles have the code shared on that repo. Question number 6. Do we optimize pre-tax or after-tax? Generally, we do not take into consideration tax rate here. You can embed it into your strategy if you are investing in different countries. Now I will answer some of the 2025 questions. So the course starts today. Will we learn how to analyze the impact of tariffs on the various stock markets? I would say that we won't. It's not economics lecture, and things can become very complicated. I would suggest that you can include specific vertical indexes or other countries' stock indexes, or some factors like trade balance for countries or exchange rates as proxies for tariffs and the volume of trade. What is the timeline of the course? The timeline is approximately 2.5 to 3 months. We have 5 lectures and 2 to 3 weeks distance between those lectures. And when 5 lectures are finished, there is a 3 weeks period for a capstone project. What is your best trading strategy? As I said earlier, I do not comment on the financial performance of my own strategies. What I can say is my general approach, that I try to define different algorithms like a passive portfolio or fundamental strategies portfolio or options portfolio or algorithmic trading portfolio. And I see how these portfolios perform, and I send more money to portfolios that perform better. What are the anticipated learning outcomes of the course? What target job roles will it prepare me for, and how will it advance my professional career further? I'd say that this is a practical course for investing. We will discuss later on the potential outcomes at different stages. So I have a specific slide on this, but I wouldn't advise this course as a first course for someone who just starts the career, because it has so many different aspects and it's quite complicated. It should be different to make predictions on live flowing data and historical data. Will this be examined in the course as well? We use historical data or delayed data, 15 minutes delayed data. What we do here is called day trading, so we do not use any of the live/flowing data, but you can use it for your projects. What market will have the main focus? A stock market or forex market? Is any a significant difference between trading in each market? We will discuss mostly stock market and mostly US market, but you can select forex, you can select crypto, you can select commodities, any market you want. The principles are similar. Would you recommend to do the ML Zoomcamp first? If not, how much knowledge about coding I need to have? I'd say ML Zoomcamp or any other Zoomcamp definitely helps, and that's why I have a specific slide on this. But it's not necessarily that you finish any of these Zoomcamps. You should have some programming language. Say if you finish any course on Python or analytics, it should be enough. Is Charles Schwab a good site since they acquired TD Ameritrade, or is Interactive Brokers better? You can trade from any broker. There are many comparisons on their user interface, fees, and markets that you can access. For our course, it doesn't make any difference. How this edition of Stock Market Analytics Zoomcamp is going to differ from the previous one. It is similar. Let's say 80 to 90% of content is the same, but the data is different. We have the data for the whole new year, and all home assignments are new and different. What career impact can this Zoomcamp have for a fresher in data analysis? I'd say it's a good project for your portfolio, but it's not the easiest one. So you can finish some other courses faster with less complicated projects. How much information these courses would have about non-technical aspects? Not much. I try to add context to the home assignments and to the slides, so that you can click and read the articles, but not more than that. Does simple analysis like using technical indicators for buy-sell signal generate more wins than put more effort on building accurate model? we will discuss this. We will use hand rules and specific technical indicators first, and then try to compare with ML predictions that have those technical indicators as features. Okay, last question, and then we continue with slides. Can you give an example of Streamlit? There were two webinars in February this year and December last year, and those webinars are linked at the GitHub course page, so you can check them and check the repos from the webinars. I believe that dashboards are still alive, and you can check them as well. They were built with Streamlit. Okay, now let's move on with the content. Questionnaire. I've updated stats with the data from today. 1 month ago it was about 400 submissions, and now it's more than 1,000. We have 68 countries with more than 1 participant. Top 10 countries are USA, India, Germany, UK, Nigeria, Canada, Colombia, France, Spain, and Singapore, and they are 62% of all respondents. Then 355 of you, approximately 35%, answered that they took some of the previous Zoom camps by data talks. And as you can see, data engineering Zoom camp is the most popular one. I'd say that any of these Zoom camps will help you, and analytics in stock market Zoom camp that's we had last year will help you more than others because the content is quite similar. Then I checked all of your answers on the knowledge application, and I color-coded them, whether they are the best fit, medium fit, or low fit. So first, we will be analyzing and predicting stock market trends. We will develop trading strategies and algorithms to automate trading. We will create personal investment portfolios based on these strategies. Medium fit is cryptocurrency market and crypto trading, because you may need to have more granular data. You may need to add additional features. I'm not focusing on this, but you can definitely apply these approaches on crypto. Then we are not focusing on building financial dashboards and tools. Just if you have any automation, it should be enough. If you have a dashboard, it's very good. We will try to understand the financial markets for personal interest. So we will discuss economics, we will discuss different data trends. You can see other applications here, and these applications can help you to choose your own project. I also added other applications section just to highlight that, say, many people don't have any idea yet. That's why we have a specific question on in home assignment 1 to brainstorm on the idea. And you can see a huge variety of ideas and applications here. Hopefully all of them will be implemented. Now we talk about course objectives versus expected outcomes. I treat them as 7 levels of complexity. So if you start from the level 1, the easiest level, you get some skills. You can replicate notebooks, you can run code, so it's Python, analytics, and finance skills. Then you might want to start trading, and you can get additional skills and knowledge when you register with a broker. You transfer some funds and you practice small trades. You understand that it's not that complicated. You can see how to operate with this new industry. Then level number 3, it's a leaderboard. I know that some of you are quite competitive, and we have a leaderboard which is updated every week on the Data Talks course management platform, and it is transparent. So you have this link to the leaderboard in the home assignment. You can check it every day. So some of you want to compete and to complete all homework assignments and all open-ended questions. That's great. Then you might want to build a portfolio so that you create your own project that generates trade recommendations, that utilizes your local knowledge and your own passion, and you share it on GitHub or in social networks, so that it's your own thing. Next level is that you start to do the investing decisions with the code from that project. So you customize the code for your market, your product or idea. You experiment with the models. Hopefully you can reach profits, like consistent profits, not one-day profits, but every month, every 3 months, you can have some returns on paper or real money trading. And the most complicated objective is a long-term sustained profitability. That you can not only develop one model, but you constantly look after this model or other models. You track your trades, you understand your mistakes, you add more features, and you start using this knowledge from today to the next few years. Now let's talk about understanding data-driven decisions. So here we start from some macroeconomics indicators, and we will check how these indicators can be obtained with Python code, just with a few lines of code. So you can open the code. So if you type colab.research.google.com and select GitHub and select the address from the notebook, so you should be able to find this and open this notebook, and then you can connect a new runtime, and you can run all and follow what I show you here. So I have this notebook opened with saved runs, and for the data section we have a few imports before, just a few libraries. The most important library is YFinance, where we get daily data for most of the financial assets. And say for GDP, we get the data with this line of code. We call pandas data reader. We call the metric GDP pod. This metric is from database Fred, and it returns a data frame like this: dates and GDP pod column. I define 2 more columns: growth year on year and growth quarter on quarter. And you may want to read what does it mean when you shift the data on 1 or 4 data points. So the logic is exactly the same for most of the data stats that we have here. We just select different metrics from a different source. We get the data frame, and then we might build some visualization. So that's what you see on the slide. Let's return to the slide. So real potential GDP. This is a US GDP. This is the first macro indicator that is used in many economic studies. You can see here that the prediction is stable. It's about 2 to 2.5% growth every year, and we observe some acceleration of growth after COVID year. But overall, the growth rate is very different now versus you see it 10 years ago or 20 years ago. Then next thing is inflation. Most of you know that all prices are constantly growing, and if you do nothing, you're just losing money because you can buy less foods or less things on money that you have. So that's why we track inflation. And there is a specific matrix on Fred. You can see these links, so you can download this matrix in the exactly same way that I showed you previously. You just substitute the metric name and you get the data for that metric. And recently in the US and many other countries, inflation was quite high after COVID, and many central banks were fighting against inflation. And many of them are successful. So inflation went down in the last 2-3 years, and it's still going down. So core CPI declined from 3.7% last year in February 2024 to 2.8% in March 2025. Now you know that you need to save money with the rate higher than 2.8% just to have the same buying power. Now let's think a little bit about your personal saving options. Let's assume that you have income in dollars or euro. You know your inflation rate. In Ireland it's 2.2%, in the US it's 2.8%, and you think what you can do with your money. So first thing, do nothing. It's not bad, so you are not losing anything. It's 0% interest, it's full liquidity, you can use your money any day. Next thing, you can go to a bank and open a saving account. For example, in Ireland is 2 to 3% in euro. You might get a rate which is close to inflation, but in many countries it is lower than inflation. You have money protection scheme, so that bank guarantees to return your money or some amount of money up to some threshold. So it's still low risk, but returns are not very high. Next thing, there are money service businesses like Wise that offer you slightly higher returns on your money. And you can also transfer funds to other countries or do easier payments with these services. So strictly speaking, they may not be a registered bank in your country. It can be some global organization, and they can offer you a slightly higher returns, but it's a marginally higher returns, not high enough. And strategy number 4, you open a broker account and try to invest money there. In some broker accounts like Interactive Brokers or Trade Republic, you can get a decent return on your uninvested money, like up to 4% in dollars. In Interactive Brokers, it's down from 4.8% last year, and up to 3.25% interest on Euro cash in Trade Republic. But there can be some additional conditions that your money do not have a protection scheme, or you need to have minimum 10,000 on your account, etc., etc. When you already have some of your money on broker accounts, you are thinking, what can I do better? How can I invest those money? And let's assume that you're in the US, and you think, what's the benchmark? What should we see as a minimum returns on the investments? And in the US, the most important rate is a Fed funds rate. So you can read more about this rate on Fred or other links here. And the important thing is that it's slightly higher than 4%. So it used to be 5.3% last year, and now it is 4.8%, I think 4.3%. There were 2 rate cuts or 3 rate cuts in 2024, and there are 2 expected rate cuts in 2025. So if you see this, you can expect that stock markets and other markets will change their returns, especially in the US, because all these markets are connected. There is a derived metric which is called risk-free rate, and typically it's a 3 months T-bill, which is close to 4.3%. It is 4.2% now, and this rate is used for discounting, for future payments that you might get, and you need to discount it to the current payments for economic models. But for you, you can see that you want to get something which is higher than risk-free rate, which is a 4.2%. And first thing is a bonds. It's not stocks. It's a debt instruments. Say if you buy corporate debt or government debt, and essentially it's a loan, and they say that they can pay you 5, 6, 7%. It is some rate which is higher than risk-free rate, but it has some additional premium for the risk, say risk of default. So if you choose this, and it is used very often in passive portfolios, you can get regular dividends or returns, payments from bonds, and these payments can be 5, 6, 7% in the US with a small risk. Now, if you start investing in stocks, and if you're in the US, first you want to look at some broad market index, S&P 500, for example. And this index, it returned on average 10% during the last 35 years. But some years, like this year, now situation is slightly better, but as of mid-April or end April, it was minus 6%. So you could have not plus 10% or plus 5%, but you could be minus 6% just in 3 months, in 4 months of this year. So the idea that I try to deliver here, that if you expect higher returns, you should also expect more risk or more volatility of returns. And so this is a concept, rule of 72. So how quickly can you double your real capital? And approximately, if you say that I want to achieve the rate of return of 10%, then you can double your capital in 7 years. If you stay with the local bank, probably you double your capital in somewhere between 23 and 35 years. And if you're doing really well, and some years, like previous 2 years for the US stock markets, delivered more than 20%, then you can double your money in 4 years. If we combine everything that I talked previously, so what should you look at when you define your strategy? First, we want to have a positive return, and ideally positive return should be every month or every 6 months or every rolling period. So it may be not every week, but if you select randomly 6 to 12 months, you should see a positive return. Then 60 to 40 portfolio, that's a famous passive investment portfolio which combines equity, which is stocks, 60% of stocks and 40% of bonds. And this portfolio for risk-averse investors, it's delivered approximately 7% of returns, or about 5% inflation adjusted. S&P 500 index in the US had 10.5% returns, or 6.3% inflation adjusted. And now it comes a sweet spot. That's how I define a good rate of return for myself. So if I have 6 to 10% per year net of inflation every single year, I treat this year as a successful year. And it's not 50%, it's not 30%, just you can compare yourself versus most famous hedge funds and investors like Warren Buffett, who delivered 20% of average growth, average annual growth rate over several decades. So if you believe that you can be better than Warren, probably you can try to define a higher rate of return for your portfolio. And you can also check some of the largest hedge funds like Renaissance Technologies. They said that they achieved 66% average annual growth rate, which is incredibly high. Continuing previous slide, there can be different asset classes like stocks of US stocks, or emerging market stocks, or commodities, or like gold or bonds, and all these classes, they have some expected annualized return. So you can see it can be 4% or it can be 12%. And these classes, they have annualized volatility. It's a deviation of a return or risk that you can get when you buy this class. So it can be 0% or it can be 22%. And if you combine few classes or all of these classes, there is a theoretical efficient frontier, which is a theoretical concept, but it's good to understand that if you select a few investment classes, you can get a nearly optimal theoretical returns from those classes, and you can calculate those returns using historical correlations. Now let's think about more practical things, what you need to do when you think about your project and when you are thinking about yourself. So first, you need to decide about your risk tolerance. What's your expected return? What's your maximum drawdown? What are you going to do in the next few years? And as a general guidance, it is often recommended to take more risk earlier when you don't have a lot of capital, and you can make mistakes, but you can also learn on how to invest in different asset classes. But when you do it for 10 or 20 years and you have some capital, you're selecting more risk-averse strategy. Then you try to define success, whether you select some benchmark like S&P 500 index, or you can define specific metrics like Sharpe ratio, Sortino ratio, or maximum drawdown that define your success and constraints for the portfolio selection. From a data perspective, it's important to understand that all markets are interconnected, and we are building some form of model of a world. So we are using data, a little bit of data from all major investment classes or markets, and then we add more data on a specific vertical or specific country, trying to predict that small market, but understanding that that small market is connected with the major large markets. And now let's have let's talk about Colab. I saw questions on Colab, why I'm using it, and whether I ask everyone to use it. Of course, you can use whatever you want. I use Colab because of a few things, that it's low barriers to start. So you do not depend on your environment, it runs in your browser, and in many cases it's enough for our goals. Then you have you already have a lot of pre-installed libraries. You have free GPU, TPU access. That's useful when you're training models that have millions of records with say 200 features that we can generate during this course. So it can increase the speed of your model training. It's easy to share with everyone, it's easy to save, and you can see the output. You can also have dynamic visualizations after the output is produced. There are some graphs that are rendered on a website, and you can select countries, say on the country split, and or you can select specific date and you can see a value that is shown on that graph. So that's very convenient. It's cloud-based, so any device, anywhere, auto-saves your work. There are some pros as well. Sessions may disconnect, and they will definitely disconnect if you wait, say, more than 1 hour. You may need to re-upload files if you're using some local files, but you can also use your drive and you don't need to upload files, or you can use a database. Then there are free tier usage limits. So there are paid plans for Colab. In most cases, free tier usage limits is enough. What else do I use? I normally develop in Jupyter Notebooks, Anaconda, with a full local control. And I normally have an IDE like VS Code. I showed this setup at the previous workshops in December and February, and it's extremely convenient and useful because it has a powerful AI assisted development. You need to pay some money for this, but it's, as of today, it's much more powerful than AI in Colab. So what are the data sources for the stocks you might want to use? I'll talk about them now, and I will show them in a Colab. First, it's YFinance. It's a free data source, and it's open, high, low, close volume data. We use daily data, but you can have hourly or minute data with lower minimum and maximum start dates. Say if you use hourly data, you might have only 2 years of history from YFinance. But if you select Polygon.io or Alpha Vantage or any other paid provider, you can get all of this data for more years. Then we will generate technical indicators from that data. This is covered in Module 2. And we will use a library called TA-lib, and it will produce approximately 100 technical indicators. So if you're a technical trader, you will see very familiar features in a data set that we will build. Then you saw some examples of macroeconomic data. I'm using usually somewhere between 50 and 60 features from this data set thread. If you are investing in Europe, you might want to use some other database on macroeconomic data like Eurostat. It's slightly harder because their API is not that convenient, but it's possible to use. Then if you're doing a model on financial on stocks, you might want to use financial reporting stats in some way. That can be earnings per share, profitability, revenue, and financial metrics that companies provide every quarter and every year to the regulator. I saw many of you want to analyze news. I wrote a few articles about it on pythoninvest.com. It's quite challenging to analyze news because normally free or paid providers, they do show you news only from a short period of time, and if you want to train your model on 25 years of data, it can be hard to generate features for from the use of 25 years of data. Okay, fundamental data. Here it's a synonym for financial reporting. So Yahoo Finance, a free provider, will give you some snapshot of a fundamental data of financial reporting for the last 1 to 4 years. If you use paid providers, you can get 25 years data easily. You can also do web scraping, which is harder, but sometimes you have to do this because it can be too expensive to get data from paid providers. Then if you are building something, some model in a specific vertical, you might want to use alternative data. It can be anything: social media sentiment, app usage, credit card data, Glassdoor reviews, YouTube videos or commentaries, web traffic on websites, satellite imagery, anything that is connected to the companies or stocks that you want to invest in and you want to build a model. Events are also quite powerful indicators, and we want to consider, we want to understand what are the most important events, like earning calendars when companies do the reporting, ETF flows, it's exchange traded funds, flows of money. It's another form that funds provide to the financial reporting. And they have specific dates when these flows change. So before you try to combine that many data sources, I'd advise you to play with the data. And a popular tool is called Stock Screener. You can find many stock screeners by different providers, and many of them are free. Say this one is from TradingView. I like their graphs. I like their description of metrics and what are the values for the metrics that you might want to find. Say if I want to look at the US market, only companies in S&P 500 that pay some dividends more than 2%, that are growing on revenue more than 0% year on year, that are not too expensive. This metric PEG less than 0.5, and that have upcoming earnings next week. You can get this with just a few clicks, and then you get some understanding on the data. So I highly recommend to play with these stock screeners. Okay, let's look at the main data source, daily data. So if you scroll down here, data sources for stocks, indexes, you will have home assignments that is already published, and that home assignment uses this data provider, I think, in every question. So you can just reuse this code. So there are there are a few examples. You need to import Yahoo Finance library. When you imported this library, you select a ticker, and this is index ticker for a German stocks market, DAX daily. When you download data for this ticker, you can specify start and end dates, and you get data like this: open, high, low, close, volume, and you can generate additional columns based on this data, say growth year over year. It's about 252 trading days in a year. You can divide close value for this day on a close value for 1 year ago, and you will have a growth of this index year over year. Okay. I also suggest you to read some of the examples. YFinance, the definitive guide, or Yale lectures, just to check the code there and the description on the available options. We won't focus today on the paid data. I think if you're using if you want to have some news data, you have to use some paid data providers or free tier on those paid data providers. So I added links on my articles on the financial news summarization that is using Polygon.io news API. Alpha Vantage also offers 25 free calls, and my last article on the fundamental data uses Alpha Vantage, so you might find some good data there as well. Macroeconomic stats. In most cases, we will use stats from FRED, Federal Reserve Economic Data. If you open that website, there are thousands of data points, and you may not know which data points to choose. That's why I suggest that you try to check on other sites what are the mostly used macro indicators, like these US indicators, and you can then search for those indicators on FRED and find those data points. Otherwise, it's quite hard to compile a good subset of metrics on macro from FRED. Financial reporting. I provide some links here that you can download data from the stock exchange for free, but usually they are not very structured. They are not compiled into one data frame. So if you can write code for this, you can download this precious data for free. Web scraping. I had a few articles on this, and the idea is that there are numerous financial websites, and they can provide a good data that you want to use on the web browser UI, and sometimes these websites can even give you an opportunity to download this data. If you open this coin company's market cap page, let's open it now. You can see this button, download the list. So you can, in this case, you can quickly get data from this website. But many others, they are not. I won't use this during this course, but please take a look at things like Google Trends or Twitter sentiments. They can be quite powerful as well. Recap for today. What we learned today. First, we discussed concept of a financial rate of return and efficient frontier and the balance between risk and reward. Then we were chatting about how you're gonna develop your investment idea, what are the features for the capstone project that you might want to get. We looked at some of the macroeconomic data and indicators. We checked stock data sets, and now we will cover a cheat sheet for starting a project. If you simplify all of these materials, here is a step-by-step guide what you need to do for your project. First, you select one market or a country. You can go global as well, but it's harder to get a good data set for this. Then you choose one or a few benchmark to compare with. It can be an index or some good performing asset class, or it can be even a banking rate of return. Then you select macroeconomic indicators or some other indicators that might affect your specific market. Next step, you think about the dataset size. How many companies do you want to include? What a time period and history do you need? In this course, I normally use 25 years of data, and I ask to have more than 1 million of rows in your data set, so that our ML model with hundreds of features can be trained in some way and produce good results. Then you need to decide, do you need the fundamental data? Normally it's hard to get this data. Can you provide only 4 years of data? Do you need to scrape this data, etc.? And last step, do you want to include any alternative data? Important note is not to leak the data. At any point, at any date, you need to include the data that is already available at this date. So you can't include something that will be reported at the end of the year or at the end of the quarter if you have a historical data, because it will bias the estimation, and you won't get the correct predictions. And lastly, some generic recommendations for the course. Be active, ask questions and contribute to discussions. You have Telegram, you have Slack. If you have any problems, I regularly check those channels. You can ask questions and hopefully you can help each other. Prefer the simplest option when possible and build on it. So you can reuse class materials, you can start from one stock, you can start from 10 features. Do not try to build the best picture of the world just from the attempt number 1. Then home assignments, they are important. They are designed to be straightforward. They are not always simple, because I want you to get some intuition in the recent economic advancements and data, and sometimes the technical aspects can be quite hard, because you need to spend some time when you download the data, when you work with the data and get some result. So I don't expect you to solve all home assignments, but please try to solve one problem, two problems, like do something every single lecture. And you will see that there are different point assignments close to the assignment, to the questions. Next, start working on the project early. And it's not only about projects, it's also about home assignments. Every single week and every single time I see people who are asking to extend the deadline. So my best advice to you is to start working on the assignments today. And last but not least, leverage your edge. So if you're just starting out, build new skills and build a portfolio that will be helpful for your next job position. Then if you're already investing in some local market, consider choosing that specific market. If you're an advanced software engineer, you can build a simpler model or simpler data set, but more complicated automated solution as a project. Same advice is for ML practitioner or a trader. And if you're a student, then you have the most precious resource, time. So I saw some examples when people had zero experience, but they spent 3-5 times more than others on average, and they succeeded. So they finished with the capstone project. Homework. So homework, actually I think it has 4 questions and 2 extra. It's already published in 2025 cohort homework 1.mg. The deadline is to submit within next 2 weeks, so end of Monday, GMT +1 time. You can get extra points by posting your homework and tagging Python Invest and Data Talks Club. This year we reduced these points from 7 to 3. First of all, we want everyone to solve the questions and not just post those questions on a social media. And we can check the homework, so it's here. There are questions, S&P 500, there are links. You can see the context just for you to understand what to expect, why I ask these questions, and what should be the answer. So 4 questions, question number 2, number 3, and number 4. Sometimes I make your life easier, so I do not provide, I don't ask you to download data from YFinance to scrape the data. I scraped it already and I added it to the folder, so you just download the CSV and work with the data frame. Or sometimes I provide the part of an answer. In question number 3, I ask to get the median duration of significant market corrections, and I show you examples of top 10 market corrections. So if you solve this question, you can just check what you have, and if it's approximately correct, then you can get your final answer. And then 5 questions, number 5 and number 6, they are exploratory, to think about your capstone project and to investigate on the new metrics. You have a form for submitting. you can see that it's already open. Due date is 2nd of June and it will be your local time. Here are numeric answers, and you need to provide homework URL. Please provide a real URL for GitHub or Gist or any other URL that shows your code. Okay, I think that's it for today, folks. See you in probably 2 to 3 weeks. I will announce on the next date on Telegram and Slack, and I will plan the live stream on YouTube as well. Thank you guys, and happy learning.